Hello guys, welcome back to another Linktree trading video. In this one we're going to be doing some breakdown analysis on Nike, ticker NKE, see where we're likely to see this. So obviously back in June it did a massive gap. This was off good earnings, was the main reason for its big gap, and hasn't yet pulled back and filled in this gap. So since this move we have seen the stock obviously continue its upward momentum, but has since kind of pulled back since the last month or so. So kind of where do we see this going now? Firstly, as always, we look for gap fills, because gap fills 90% of the time get filled, so they're always a good thing to be looking out for. So 133, we would on a statistical basis imagine the stock will come back to this at some point, and as the stock does kind of look like it's putting back, would it be unlikely for this to be our key target as of now? But what kind of areas are we looking for? Obviously none of this gap was filled until Friday, so now we still have to fill the area between 148 and 133, so obviously a big move, but that will most likely get filled. It's just a matter of when. So for now, where can we kind of see it going? Well, we have created some new gaps. So obviously we now have a gap from 149.50 all the way to 159.60. So again, most likely going to get filled. So this could mean two things. Firstly, we could pull back now, kind of fill this gap before continuing down, or we could continue down, fill this gap, and then continue up. Either way, one of those two are going to have to happen, because you're going to have to somewhat kind of fill that gap. So that's the main thing we would be looking at for now, is either a target of 133 to the downside, or upwards target of 159.60. Now we'll go over to standard deviations, and we can see kind of what those price targets are using that. And as you can see, actually right away, it does kind of line up somewhat with the standard deviations, with the lines we oh actually no, sorry, never mind, because these are gap fill levels. So keep an eye on those levels. You can put them on your own chart, so I'm going to clear them so it doesn't confuse us on the standard deviations. But now we're on that, we have where we are right now, 148.40, and we had a bounce off this. That's because it's first deviation, and what usually happens off here, you will get a bounce, as we're starting to see now. A lot of buying pressure comes in here, because that's when the stock's deemed oversold and is considered a good low risk entry. So usually what happens off this is you'll usually at least move to the half deviation, if not the statistical mean. So from that, we should mean it will bounce off this 148.40 level, and we should probably see it go to at least 155, even if it's going to continue down. That's a likely target where we would see it going. So yeah, 155, kind of keep an eye out for that level, because most likely it would come there, even if it's going to continue down. But again, if it's continuing down, where is our next buy target? 145.70 is that level again where we most likely see the same thing, a bounce, if not come to this next deviation, or half deviation, and in this case that would be this first deviation. So most likely off this we would get about a $3 bounce, and then again, if we were going to continue down, it would at least usually make that pullback before continuing down, so we can see that. And then if it does continue down, price targets a bit further down would be the kind of 134 all the way down to 132. Those are also key levels to be putting out, because you'll see that the standard deviation lines up with the gap fill, which isn't just kind of a coincidence. You see that all the time with standard deviations, because it tends to just be how stocks trade. They trade off, you know, it's a lot of it is algorithm based now, so they do it off data, and standard deviation is using data sets or a percentage of data to kind of find your deviations. Obviously, if you're using these golden deviations, which are first deviations, 68% of data are within those. The blue deviations, second deviations, 95% of data is within those. Green deviations, third deviation, and that means 99.7% of the data should be within those, and that's why you tend to see bounces at those levels, because that's usually where, if not retail traders are getting in, there is at least definitely hedge funds, asset management firms, maybe even banks, usually just anything, high frequency traders, whatever it is, usually algorithm based trading will usually take place at these levels, and that's why you see them usually lining up with other levels. So that's a key thing to be looking out for. That 134 to 131 would most likely provide a strong bounce level, and a low risk buy opportunity. So that would be our key level, and it also, because you got all that support of one area, also tells us when the stock continues down, that is a good price target to have. So if you are short, whether that's in options or actual shares, that's a good price target to have of around 135 would be a good area to maybe start locking that profit in. Now, where do we see maybe to the upside? If it does decide to kind of continue up instead of filling the gap, then we would be looking at this 162 will be a key level. We would struggle here, and you'll actually see on the daily chart, it kind of retraced back to the statistical mean, tried to break through, and you'll see failed. So we would be looking for that kind of same kind of thing happening into this 162, is it will come and test it, and then you'll usually get a sharp reaction either way. It doesn't tend to hover on there too much, so it'll come into this 162 and either usually gap down or have a large sell-off, maybe down to 155, or should break through quite strong and probably push up to the 170 area, and then we would be looking at kind of short targets or profit lock-in areas of around 173 to 176. Again, if it decides to break through that, we would be pushing to an all-time high, or at least a 52-week high, and our levels to be trading it would be 186 to 190. Again, those would be lock-in areas if you're long, and would be deemed as low-risk short areas. So obviously there are other targets on the screen, but those are the only ways we'll really kind of go through now, because they're ones where you can see in the near future and would be tradable off the bat. If the stock kind of goes out to any other targets, if it goes below that 130 or above 190, we would make a new video and update that. But just so you know, if you wanted the quick targets now, I mean, you can see them on screen, but these would be all the targets that you would be looking at. Obviously on the downside, they're good areas to lock in profits if you're short or get long, usually low risk. And on to the upside, again, deviations above the statistical mean are usually good lock-in areas if you're long, and also a good time to be shorting or lower risk short if you're looking to short the stock. Obviously if you're investing in it long term, you probably don't want to be paying too much attention to this unless maybe it's at the third deviation on either the bottom or top side. If it's at the third deviation on the long side, I mean on the bottom side, and you're investing and you want to maybe invest more, definitely a good great buying opportunity. If it's at the third deviation on the upside, could still be a good idea to maybe lock in some profits, especially if you've been holding it over the year for capital gains. But if you haven't been holding it over the year for a year, then obviously it'll be down to you. But that's a breakdown on Nike. Hope you enjoyed the video. Hope you see you in the next one, and that's it. Peace.